Welcome to Contrarian Edge, the channel for people who refuse to follow the financial herd. I'm here to challenge everything you think you know about money. And today, we're starting with what might be the most dangerous financial advice ever given. If you've ever been told that saving money is the path to financial security, if you've ever felt proud about the growing balance in your savings account, if you believe that being a good saver makes you financially responsible, then what I'm about to tell you might completely shatter your worldview. Here's the uncomfortable truth nobody wants to talk about. Your grandmother, who lived through the Great Depression and saved every penny, who never spent money on anything unnecessary, who religiously put money away for decades, might have unknowingly trapped herself in a cycle of financial mediocrity. And if you're following her playbook, you're walking straight into the same trap. I know what you're thinking. This sounds insane. Saving money is good, right? It's responsible, it's safe, it's what smart people do. Every financial advisor tells you to save. Your parents told you to save. Society rewards savers and shames spenders. But what if I told you that this entire belief system is not just wrong, but actively harmful to your financial future? What if everything you think about money is wrong? What if the very behavior you believe is protecting you is actually the thing that's quietly making you poor? What if the financial security you think you're building is actually an illusion that's becoming more dangerous with each passing year? Today, we're going to explore a radical idea that goes against everything you've been taught. We're going to examine why traditional saving, the kind that made sense for your grandparents, might be one of the worst financial strategies you could pursue in today's economic environment. And more importantly, we're going to uncover what the wealthy actually do with their money, while everyone else is busy being good little savers. But before we dive deep, let me be clear about something. This isn't about being reckless with money. This isn't about encouraging you to spend everything you earn on designer handbags and expensive cars. This is about understanding the fundamental difference between preserving wealth and growing wealth, between feeling safe and actually being safe, between financial education and financial indoctrination. You see, most people confuse saving with investing. They think putting money in a savings account is the same as building wealth. They believe that watching their account balance grow means they're getting ahead. But here's the thing that nobody tells you. In today's economic reality, traditional saving isn't preservation. It's slow-mo motion, financial suicide. Think about this for a moment. When was the last time you met a truly wealthy person who got rich by saving money in a bank account? When was the last time you heard about someone achieving financial freedom through traditional saving methods? The answer is probably never. And there's a very good reason for that. The wealthy understand something that most people don't. They understand that money sitting in a savings account isn't working for you, it's working against you. They understand that in an inflationary environment, which is basically every environment in modern economic history, holding cash is like holding ice in the desert. It might feel substantial now, but it's melting away every single day. But here's where it gets really interesting. The same financial institutions that pay you virtually nothing on your savings are using your money to generate massive returns for themselves. They're taking your deposits and lending them out at rates that are multiple times higher than what they're paying you. They're using your money to buy real estate, to invest in businesses, to purchase government bonds, to do exactly what they should be encouraging you to do. But instead, they're encouraging you to keep giving them more money to play with. This is the first uncomfortable truth we need to face. Banks don't want you to become wealthy. They want you to be a good customer. They want you to keep depositing money that they can use to make themselves wealthy, while paying you just enough to keep you happy. but not enough to actually build real wealth. Over the next several episodes, we're going to completely deconstruct the saving myth. We're going to examine exactly how inflation is eating your savings alive, why the wealthy never save money the way you've been taught to save money, and most importantly, what you should be doing instead. We're going to look at real numbers, real examples, and real strategies that can transform your financial future. If you're ready to challenge everything you've been taught about money, if you're ready to think like the wealthy instead of thinking like the masses, then you're in the right place. This is Contrarian Edge, where we don't just follow conventional wisdom. We question it, we test it, and when necessary, we completely reject it. The belief that saving money is a virtue didn't appear out of thin air. It's deeply rooted in historical circumstances that no longer exist, yet we continue to follow this outdated playbook, as if the economic landscape hasn't fundamentally changed. To understand why saving has become a trap, we need to examine where this belief system came from and why it's no longer relevant to our current reality. The golden age of saving occurred primarily in the post-World War II era, roughly from the 1950s through the early 1980s. During this period, your grandfather could actually walk into a bank and get a savings account that paid real returns. We're talking about interest rates that not only kept pace with inflation, but actually exceeded it by meaningful margins. In the late 1970s and early 1980s, savings accounts were paying double-digit interest rates. Imagine getting 12 or 15% on your savings account. In that environment, saving money wasn't just safe, it was actually profitable. But here's what happened. That era created an entire generation of financial thinking that became deeply ingrained in our culture. Parents who lived through this period passed down the saving mentality to their children, who then passed it down to their children, creating a multi-generational belief system based on economic conditions that disappeared decades ago. We're essentially following a roadmap to a destination that no longer exists. Think about the financial education you received growing up, whether it came from your parents, your school, or early financial literacy programs. It probably focused heavily on the importance of saving money. You were taught to live below your means, to put money away regularly, to build up your savings account, and to avoid debt at all costs. These lessons were presented as timeless wisdom, universal truths that would serve you well regardless of economic conditions. But this traditional financial education creates a dangerous false sense of security. It makes people believe that accumulating cash in low-yield accounts is equivalent to building wealth. It encourages a scarcity mindset, where the primary goal is preservation rather than growth. It teaches people to be afraid of risk without teaching them to understand the difference between intelligent risk and reckless speculation. The most insidious part of this outdated thinking is that it feels responsible when you're putting money into a savings account every month. When you're watching that balance grow, when you're avoiding debt and living modestly, you feel like you're doing the right thing. You feel financially responsible. You feel like you're building security for yourself and your family. But feelings and reality are two very different things. Let's look at what actually happens when you follow this traditional saving approach for an extended period. Imagine someone who started saving diligently in the year 2000. They put away money consistently. They lived below their means. They built up a substantial savings account over 20 years. Meanwhile, during this same period, real estate prices doubled, tripled, or even quadrupled in many markets. Stock market indices generated average annual returns of 8 to 10%. Even relatively conservative investments significantly outpaced the returns available in savings accounts. The person who followed traditional saving advice didn't just miss out on potential gains. They effectively went backwards, relative to the cost of living, and relative to asset prices. While they were being responsible savers, they were simultaneously being excluded from the wealth-building opportunities that were available to anyone willing to think differently about money. This creates a particularly cruel irony. The people who are most focused on financial security, the people who are most concerned about protecting their money, are the ones who end up being least prepared for the economic realities of the modern world. They're like people who are so afraid of flying that they choose to drive everywhere, not realizing that, statistically, driving is far more dangerous than flying. The traditional saving mentality also fails to account for the opportunity cost of holding cash. Every dollar sitting in a savings account earning minimal interest is a dollar that could be working much harder in other investments. Over long periods of time, this opportunity cost becomes enormous. We're not just talking about missing out on a few percentage points of return. We're talking about the difference between financial mediocrity and financial freedom. But perhaps the most dangerous aspect of the traditional saving approach is that it's based on a fundamental misunderstanding of what money actually is in our current economic system. Money today is not a store of value the way it was when it was backed by gold. Today's money is designed to lose value over time through inflation. Central banks explicitly target inflation rates of 2% or higher. This means that money sitting in low-yield accounts is guaranteed to lose purchasing power year after year. The wealthy figured this out long ago. They understand that in an inflationary monetary system, holding cash is equivalent to holding a depreciating asset. That's why they don't save money in the traditional sense. Instead, they immediately convert excess cash into assets that can maintain or increase their value over time. They think in terms of purchasing power rather than nominal dollars. They focus on real returns rather than the illusion of safety that comes with traditional saving. Inflation is the silent killer that nobody talks about in polite financial conversation. While everyone focuses on dramatic market crashes and obvious financial disasters, inflation quietly erodes wealth in a way that's almost imperceptible on a day-to-day basis, but devastating over the long term. If you're a traditional saver, inflation isn't just your enemy, it's your executioner. And most people don't even realize they're on death row. Let's start with a fundamental distinction that most people never make. There's a massive difference between saving money and hoarding cash. Saving implies that you're preserving value for the future. Hoarding cash means you're accumulating pieces of paper or digital entries that are systematically losing their purchasing power. When most people say they're saving money, what they're actually doing is hoarding cash, and there's nothing financially intelligent about that behavior in an inflationary environment. The official inflation numbers that governments report are carefully crafted to minimize panic and maintain confidence in the currency. But anyone who actually purchases goods and services in the real world knows that the true cost of living increases far exceed these sanitized statistics. The methodology for calculating inflation has been changed multiple times over the decades, almost always in ways that make the numbers appear lower than they would under previous calculation methods. Let's examine what's happened to purchasing power since the year 2000. If you had put $100,000 into a typical savings account in 2000, and assuming you could get an average interest rate of around 2% over the past 23 years, you would have approximately $158,000 today. That sounds like growth, right? You've made $58,000 just by being a responsible saver. But here's the reality check that will make you sick to your stomach. That $158,000 in today's money has roughly the same purchasing power as $65,000 had in the year 2000. You didn't preserve your wealth, you lost more than a third of it. While you thought you were being financially responsible, inflation was systematically robbing you of your purchasing power, and a minimal interest from your savings account wasn't even close to keeping pace. Now, let's look at what happened to real assets during this same period. The median home price in the United States in 2000 was approximately $120,000. Today, that same median home price is over $400,000. Someone who used that $100,000 as a down payment on real estate in 2000 would have participated in this appreciation. Someone who kept it in savings missed out entirely. The S&P 500 index, which represents the 500 largest publicly traded companies in America, was trading at around 1,400 points in 2000. Today, it trades at over 4,000 points, and that doesn't even include the dividends that were paid along the way. An investment in a simple index fund would have nearly tripled the initial investment while generating regular dividend income. Even gold, which is often criticized as a non-productive asset, was trading at around $300 per ounce in 2000 and is now over $2,000 per ounce. Every major asset class significantly outperformed traditional savings accounts, not because these investments were particularly speculative or risky, but because they maintained their purchasing power, while cash did not. This brings us to one of the most important concepts in finance that nobody teaches in basic financial education. The difference between nominal returns and real returns. Nominal returns are what you see in your account statements. Real returns are what you can actually buy with that money after accounting for inflation. Traditional savers focus on nominal returns because they make you feel good. Intelligent investors focus on real returns because they determine whether you're actually building wealth or just maintaining the illusion of progress. The inflation problem becomes even more severe when you consider that the largest expenses in most people's lives, things like housing, healthcare, and education, have inflated at rates far exceeding the general inflation rate. Housing costs have increased dramatically faster than general inflation. Healthcare costs have increased dramatically faster than general inflation. College tuition costs have increased at multiples of the general inflation rate. This means that if your investment strategy is simply trying to keep pace with official inflation numbers, you're still falling behind in terms of affording the things that matter most in your actual life. You need investment returns that significantly exceed official inflation rates just to maintain your current standard of living, let alone improve it. But here's where the psychology of traditional saving becomes particularly dangerous. Small nominal gains in savings accounts create a false sense of progress that prevents people from taking the actions necessary to protect their purchasing power. When you see your savings account balance increasing every month, even by small amounts, your brain interprets this as financial progress. You feel like you're moving in the right direction, so you continue with the same strategy that's actually moving you backwards in real terms. This psychological trap is one of the reasons why inflation is such an effective wealth transfer mechanism. It allows governments and central banks to systematically reduce the purchasing power of cash holders, while most people don't even realize it's happening. The people who suffer most from this process are the ones who are trying to be most responsible with their money. The people who benefit most are those who understand how to protect themselves by holding real assets instead of depreciating currency. The cruel irony is that the behavior that feels most safe, holding cash in insured accounts, is actually the behavior that guarantees you'll lose purchasing power over time. Meanwhile, the behavior that feels risky, investing in productive assets, is actually the behavior that protects you from the systematic erosion of your wealth through monetary inflation. When you walk into a bank and open a savings account, you're not entering into a partnership where the bank helps you build wealth. You're entering into a transaction where you become the product being sold. Banks have successfully convinced an entire generation that they're providing a valuable service by taking your money and paying you virtually nothing for the privilege. While they use that same money to generate substantial profits for themselves and their shareholders, let's examine the mathematics of this relationship, because the numbers reveal exactly how one-sided this arrangement really is. As of 2023, the average savings account in the United States pays somewhere between 0.01% and 0.50% annual interest. Meanwhile, banks are lending that same money out for credit cards at rates between 18% and 29%, for personal loans at rates between 6% and 15%, and for mortgages at rates between 6% and 8%. Even in the most conservative scenario, banks are earning 10 to 20 times more on your money than they're paying you for it. But the spread between what banks pay depositors and what they charge borrowers is only part of the story. Banks also use customer deposits to purchase government bonds, corporate bonds, and other securities that generate returns far exceeding what they pay to savings account holders. They're essentially running a massive arbitrage operation using your money as their capital, and they're keeping virtually all of the profits for themselves. Think about this from a business perspective. If someone approached you with a proposal where you give them money, they use that money to generate returns of 8% to 25%, and then they pay you 0.1% for providing the capital. Would you consider that a good deal? Of course not. You'd laugh them out of the room. Yet this is exactly the arrangement that millions of people have with their banks, and somehow we've been convinced that we should be grateful for it. The banking industry has masterfully marketed this arrangement as a service rather than what it actually is: a wealth transfer from depositors to bank shareholders. They emphasize the safety and convenience of savings accounts, while carefully avoiding any mention of the opportunity cost or the real purchasing power implications of earning sub-inflation returns on your money. Let's compare what you could earn with that same money in other investments that are readily available to ordinary investors. A simple S&P 500 index fund has generated average annual returns of approximately 10% over the past several decades. Real estate investment trusts, which allow you to invest in real estate without directly purchasing property, have generated average annual returns of 8% to 12%. Even conservative government bonds have historically provided returns that exceed savings account rates. More recently, alternative investments like Bitcoin have provided returns that make traditional investments look conservative by comparison. While Bitcoin is certainly more volatile than traditional assets, someone who purchased Bitcoin just 5 years ago and held it through the volatility would have dramatically outperformed any savings account, even accounting for the significant price fluctuations. But the comparison isn't just about the returns themselves. It's about what those returns represent in terms of purchasing power and long-term wealth building. When you're earning 0.1% in a savings account while inflation is running at 3% to 8%, you're not preserving wealth, you're systematically destroying it. When you're earning 10% in an index fund while inflation is running at 3% to 8%, you're not just preserving wealth, you're building real purchasing power over time. The psychological aspect of this arrangement is particularly insidious. Banks have created an environment where people feel secure about earning virtually nothing on their money because the principal amount appears to be guaranteed. But this guarantee is meaningless if the purchasing power of that principal is steadily declining. It's like guaranteeing that you'll get back the same number of ice cubes you put in the freezer, while ignoring the fact that the freezer isn't working and the ice is melting. Furthermore, the supposed safety of bank deposits is largely an illusion in today's economic environment. Yes, deposits are insured up to certain limits, but that insurance is provided by governments that are themselves financially stressed and printing money at unprecedented rates. If there were ever a systemic banking crisis severe enough to threaten large numbers of banks simultaneously, the insurance funds would likely be inadequate, and the government response would probably involve printing more money, which would further devalue the currency you're trying to protect. Meanwhile, the wealthy understand that real safety comes not from government guarantees or insurance schemes, but from owning productive assets that can maintain their value regardless of what happens to the currency. They own businesses that can raise prices with inflation. They own real estate that tends to appreciate with inflation. They own stocks in companies that can adapt to changing economic conditions. They own commodities and precious metals that have intrinsic value independent of any particular currency or government. The banking system, as currently structured, is designed to benefit banks and their shareholders at the expense of depositors. This isn't a conspiracy theory or an anti-bank rant. It's simply the logical result of the incentive structure that exists in modern banking. Banks profit by paying as little as possible for deposits while earning as much as possible on loans and investments. Depositors who accept these terms are essentially subsidizing the wealth accumulation of bank shareholders while sacrificing their own financial progress. The first step toward breaking free from this system is recognizing that your bank is not your financial advisor. Your bank is a profit-maximizing business that makes money by convincing you to give them your money in exchange for below-market returns. Once you understand this relationship clearly, you can begin to make decisions based on your own financial interests, rather than the marketing messages designed to keep you as a profitable customer for the banking industry. When Robert Kiyosaki wrote Savers or Losers in his best-selling book Rich Dad, Poor Dad, he wasn't trying to be provocative for the sake of controversy. He was articulating a fundamental truth that separates the wealthy from everyone else. The recognition that in modern monetary systems, saving cash is a losing strategy, while acquiring income-producing assets is the path to financial freedom. The wealthy don't save money in the traditional sense because they understand that money itself is not wealth. Money is simply a tool for acquiring wealth. This represents a completely different mindset about what money actually is and how it should be used. When average people receive money, they think about saving it, spending it, or perhaps investing a small portion of it. When wealthy people receive money, they immediately think about converting it into assets that will produce more money. They don't see cash as something to be accumulated. They see it as something to be deployed as quickly and efficiently as possible. Consider how billionaires actually manage their wealth. Warren Buffett, one of the world's most successful investors, keeps virtually no cash in traditional savings accounts. Instead, he continuously deploys capital into undervalued businesses and stocks. When Berkshire Hathaway accumulates cash, Buffett considers it a problem to be solved, not an achievement to be celebrated. He's constantly looking for ways to convert that cash into productive assets that will generate returns over time. Jeff Bezos built his wealth not by saving money from his job, but by constantly reinvesting in Amazon's growth and acquiring other businesses and assets. Even after becoming one of the world's richest people, he continues to think in terms of asset acquisition rather than cash accumulation. When he needs liquidity, he borrows against his assets rather than selling them, allowing him to access cash while maintaining ownership of appreciating investments. Real estate provides a perfect example of how the wealthy think about money differently. While average people save money for years to accumulate enough cash to buy a house, wealthy investors use leverage to acquire multiple properties with the same amount of capital. They understand that in an inflationary environment, borrowing money at fixed rates to purchase appreciating assets is one of the most effective wealth-building strategies available. Let's examine the mathematics of this approach. Suppose you have $100,000 in cash. The traditional approach would be to save this money until you have enough to purchase a property outright, or to use it as a down payment on a single property. The wealthy approach would be to use this as down payments on multiple properties, leveraging the capital to control a much larger amount of real estate. As these properties appreciate and generate rental income, the wealthy investor builds equity while the properties themselves provide inflation protection. The same principle applies to business ownership. Wealthy individuals don't just save money to eventually start a business. They acquire existing businesses, invest in startups, or purchase shares in publicly traded companies. They understand that owning pieces of productive enterprises provides much better protection against inflation than holding cash, because businesses can raise their prices as costs increase, maintaining their real value over time. Commodities represent another asset class that wealthy investors use to protect against currency devaluation. When central banks print money aggressively, the prices of oil, gold, agricultural products, and other essential commodities tend to rise. By owning these assets directly or through commodity-focused investments, wealthy individuals ensure that their purchasing power increases along with inflation rather than being eroded by it. The wealthy also understand the concept of good debt versus bad debt. While financial education typically teaches people to avoid debt entirely, wealthy individuals use debt strategically to acquire appreciating assets. They borrow money at low interest rates to purchase assets that generate returns exceeding the cost of the debt. This allows them to amplify their returns while using other people's money to build wealth. Perhaps most importantly, the wealthy focus on acquiring assets that generate passive income. Instead of relying solely on earned income from jobs or businesses, they actively manage, they build portfolios of investments that produce cash flow without requiring their direct involvement. This might include dividend-paying stocks, rental real estate, royalties from intellectual property, or ownership stakes in businesses managed by others. This approach creates a virtuous cycle where the income from assets can be reinvested to acquire additional assets, leading to exponential growth over time. Meanwhile, people who focus on traditional saving find themselves trapped in a linear progression where they can only add to their wealth through earned income, without benefiting from compound growth or passive income generation. The psychological difference between these approaches is profound. Traditional savers are constantly worried about losing money, so they prioritize safety over growth. Wealthy individuals are focused on losing purchasing power, so they prioritize assets that can maintain or increase their value over time. Traditional savers think in terms of preserving what they have. Wealthy individuals think in terms of acquiring assets that will provide financial security, regardless of what happens to any particular currency or economic system. This mindset shift from cash accumulation to asset acquisition is perhaps the most important mental transition that anyone serious about building wealth needs to make. It requires moving beyond the comfort zone of seeing cash balances grow in savings accounts, and instead focusing on building a portfolio of productive assets that can provide long-term financial security and independence. The wealthy figured this out long ago, which is why they continue to get wealthier while traditional savers struggle to keep pace with inflation. The difference between passive income and passive wealth destruction becomes crystal clear. When you compare two hypothetical scenarios that play out in real life every single day, let's imagine two different people, both starting with similar financial situations, but making fundamentally different choices about what to do with their money. The results will shock you and hopefully motivate you to reconsider everything you think you know about financial security. Person A is a diligent saver who manages to accumulate $1 million over the course of their working career. They're incredibly disciplined, living below their means, putting money away consistently, and finally reaching that magical seven-figure milestone that represents financial success in most people's minds. They put this money in a combination of savings accounts and certificates of deposit, earning somewhere between 1% and 3% annually. They feel secure, they feel accomplished, and they believe they've set themselves up for a comfortable retirement. Person B takes a completely different approach. They accumulate $500,000, exactly half of what Person A managed to save. But instead of letting this money sit in low-yield accounts, they deploy it strategically across a diversified portfolio of income-producing assets. They invest in dividend-paying stocks yielding 4% to 6%, real estate investment trusts yielding 6% to 8%, and perhaps some rental property generating 8% to 12% annual returns. Their average portfolio yield is approximately 8% to 10% annually. Now, let's examine what happens over time. Person A, with their $1 million earning 2% annually, generates $20,000 in income per year. After taxes, they're probably looking at somewhere between $14,000 and $16,000 in actual spending power annually. Meanwhile, Person B, with half as much principal but earning 9% annually, generates $45,000 in income per year. Even after accounting for taxes, they're generating nearly 3 times as much spendable income with half as much capital. But the story gets even more interesting when you factor in what happens to the principal over time. Person A's $1 million maintains its nominal value, but as we've discussed extensively, inflation is systematically reducing its purchasing power every year. In 20 years, that $1 million might have the purchasing power of $600,000 or $700,000 in today's money. Person B's situation is completely different. Not only are they generating superior income, but the underlying assets are likely appreciating along with or ahead of inflation. Real estate tends to maintain its purchasing power over time. Dividend-paying stocks represent ownership in businesses that can raise their prices with inflation. Even if the total return is the same 9% annually, Person B is building wealth, while Person A is preserving the illusion of wealth. The power of passive income becomes even more apparent when you consider reinvestment opportunities. Person A might spend their $20,000 in annual interest income, leaving the principal untouched. Person B has multiple options. They can spend their $45,000 in annual income and still have more spending power than Person A. Or they can reinvest a portion of that income to acquire additional assets, creating compound growth that accelerates wealth accumulation over time. Real estate provides some of the most compelling examples of how passive income can transform your financial situation. A rental property that generates positive cash flow provides monthly income, while simultaneously building equity through mortgage paydown and property appreciation. The tenant is essentially paying for your asset acquisition, while you benefit from both the income and the long-term appreciation. This creates multiple streams of value from a single investment. Digital platforms have created entirely new categories of passive income that didn't exist a generation ago. Content creators can build audiences that generate ongoing revenue through advertising, sponsorships, and product sales. App developers can create software that continues generating income long after the initial development work is completed. Online course creators can build educational products that sell repeatedly without additional effort. Even traditional stock investing can be approached with a passive income mindset. Instead of hoping for capital appreciation, investors can focus on building portfolios of dividend-paying stocks that provide regular income payments. Many established companies have been paying and increasing their dividends for decades, providing investors with growing income streams that often exceed the yields available in savings accounts by substantial margins. The key insight that separates successful investors from perpetual savers is understanding that money should never be idle. Every dollar sitting in a low-yield account represents lost opportunity to generate additional dollars through intelligent deployment. While savers focus on protecting their principal, investors focus on optimizing their capital to generate the highest sustainable returns compatible with their risk tolerance. This represents a fundamental shift in thinking from defensive to offensive financial strategies. Instead of trying to protect money from loss, successful investors focus on deploying money to generate returns that exceed inflation and provide growing income over time. Instead of hoping their saved money will be enough to fund their future needs, they build systems that generate increasing income regardless of what happens to any particular investment or economic condition. The mathematics of passive income versus passive saving become more dramatic over longer time periods. Compound growth and reinvestment create exponential rather than linear wealth accumulation, while savers add to their wealth only through additional earnings from their jobs. Passive income investors benefit from the compounding returns on their growing asset base, creating wealth acceleration that becomes more powerful over time. The choice between saving and investing for passive income isn't just about returns in mathematics. It's about creating financial systems that provide security, flexibility, and independence regardless of what happens in your career, the economy, or any other factors beyond your control. If you're currently sitting on a pile of cash in savings accounts, don't panic and don't feel guilty about the decisions you've made up to this point. You were following the best advice available to you at the time, and now you have the opportunity to make better decisions with better information. The question isn't whether you should have done things differently in the past. The question is what you're going to do differently moving forward, and how quickly you can transition from wealth preservation to wealth building. Let's start with the $50,000 scenario, because this represents the situation many people find themselves in after several years of disciplined saving. $50,000 is substantial enough to make meaningful investment moves, but not so large that you need to overcomplicate your strategy. If you currently have $50,000 earning virtually nothing in savings accounts, you're losing approximately $1,500 to $4,000 annually to inflation, depending on current inflation rates. That's money disappearing from your purchasing power every single year. While you think you're being financially responsible, the first priority with $50,000 should be education and diversification rather than trying to hit home runs with speculative investments. Begin by allocating approximately 60% of this money, or $30,000, to broad market index funds. These funds provide instant diversification across hundreds or thousands of companies, extremely low fees, and historical returns that have consistently outpaced inflation over long time periods. You can accomplish this through a simple S&P 500 index fund or a total stock market index fund available through any major brokerage. The remaining $20,000 should be split between real estate investment trusts and a high-yield money market account that serves as your emergency fund. REITs provide exposure to real estate without the complexity of directly owning property, typically yielding between 4 and 8% annually while providing some inflation protection. The emergency fund, while still not beating inflation, provides liquidity for unexpected expenses without forcing you to sell investments at potentially unfavorable times. For someone with $100,000 in current savings, the strategy becomes more sophisticated because you have enough capital to begin implementing advanced techniques like dollar cost averaging and tactical asset allocation. Instead of investing the entire amount immediately, which might expose you to short-term market volatility, consider investing approximately $20,000 monthly over 5 months. This approach reduces the risk of investing everything at a market peak while ensuring you don't wait indefinitely for the perfect entry point. With $100,000, you can also begin exploring sector-specific investments and international diversification. Consider allocating 10 to 15% to international index funds, providing exposure to global economic growth rather than relying solely on domestic markets. You might also allocate 5 to 10% to commodity-focused investments or precious metals, providing additional inflation protection and portfolio diversification. The $500,000 scenario opens up investment opportunities that aren't available to smaller investors. At this level, you can consider direct real estate investing, either through rental properties or real estate syndications that pool investor money to acquire larger properties. You might also explore private lending opportunities where you essentially become the bank. Lending money to real estate investors or small businesses at rates significantly exceeding traditional savings accounts. However, regardless of your current savings amount, the most important investment you can make is in your own financial education. Before deploying any significant capital, spend time understanding the fundamentals of asset allocation, which involves balancing different types of investments to optimize returns while managing risk. Learn about dollar cost averaging, a technique that reduces the impact of market volatility by spreading investments over time, rather than making large lump sum purchases. Study real estate investment trusts thoroughly because they represent one of the most accessible ways for ordinary investors to participate in real estate returns without the complexity of direct property ownership. Understand the difference between equity REITs, which own properties, and mortgage REITs, which provide financing for real estate transactions. Learn about different sectors within REITs, including residential, commercial, healthcare, and industrial properties. The concept of building income-producing accounts rather than dead savings accounts represents a fundamental shift in how you think about money management. Instead of measuring success by account balances, start measuring success by monthly or annual income generation. Instead of trying to accumulate the largest possible cash reserves, focus on building the most reliable and growing income streams. Create what I call a 5-year financial transformation roadmap. Year 1 should focus on education and initial asset allocation, moving perhaps 50 to 75% of your savings into diversified investments. While maintaining some cash for emergencies and opportunities, Year 2 should involve expanding your investment knowledge and beginning to explore more sophisticated strategies like international diversification or sector rotation. Years 3 through 5 should focus on optimization and expansion. As you become more comfortable with investment concepts and market behavior, you can begin exploring alternative investments, increasing your allocation to growth-oriented assets, and potentially reducing your emergency cash reserves as your investment portfolio becomes more substantial and liquid. The most important psychological adjustment during this transition is learning to measure progress differently. Traditional savers measure progress by watching account balances grow through additional deposits. Intelligent investors measure progress by watching their portfolios generate increasing income and appreciation over time. Traditional savers fear market volatility because it threatens their account balances. Intelligent investors understand that volatility creates opportunities to acquire assets at favorable prices. Throughout this transition, resist the temptation to constantly check your account balances or to make frequent changes to your investment allocation. Successful investing requires patience and discipline, characteristics that good savers already possess, but need to redirect toward wealth building rather than wealth preservation. The same discipline that made you a successful saver can make you a successful investor. Once you understand the difference between the two approaches, the most common objection to moving money out of traditional savings accounts comes in the form of a panicked question. But what if I need money immediately for an emergency? This fear of being caught without readily available cash keeps millions of people trapped in wealth-destroying financial strategies, even when they intellectually understand that their current approach isn't working. Let's address this concern head-on and explore how intelligent liquidity management differs from the primitive cash hoarding that most people mistake for emergency preparedness. First, let's examine what constitutes a real financial emergency versus the imaginary catastrophes that keep people paralyzed in cash-heavy positions. True financial emergencies typically involve unexpected medical expenses, sudden job loss, major home repairs, or family crises requiring immediate travel or support. These are legitimate concerns that require financial preparation, but the traditional advice of keeping 6 months of expenses in a savings account is both excessive and financially destructive for most people. The fundamental flaw in conventional emergency fund thinking is that it treats all money as either completely liquid or completely inaccessible. This binary thinking ignores the spectrum of liquidity options available to modern investors. You don't need to choose between having instant access to cash and building wealth through investments. You can create a tiered liquidity system that provides emergency access while ensuring that most of your money is working productively. Consider implementing what I call the 3-bucket emergency strategy. The first bucket contains approximately 1 month of expenses in a high-yield money market account or online savings account that offers competitive rates while maintaining instant accessibility. This covers immediate emergencies without requiring you to keep excessive amounts in low-yield accounts. The second bucket contains 2 to 3 months of expenses in slightly less liquid but higher-yielding investments like short-term bond funds or conservative balance funds that can be accessed within a few days if needed. The third bucket represents the bulk of your emergency preparedness and consists of diversified investments that can be liquidated if absolutely necessary, but are primarily intended for long-term growth. This might include index funds, individual stocks, or REITs that have performed well historically and can be sold relatively quickly if a major. Emergency exceeds your first and second bucket resources. The key insight is that true financial catastrophes requiring large amounts of money are rare enough that the probability of needing to liquidate long-term investments is much lower than the certainty of losing purchasing power by keeping too much money in savings accounts. Modern technology has also transformed emergency liquidity in ways that most people don't fully appreciate. Credit cards, while requiring careful management, can provide immediate access to funds during emergencies, giving you time to liquidate investments in an orderly fashion rather than keeping large cash reserves idle. Home equity lines of credit offer another source of emergency liquidity for homeowners, often at rates lower than credit cards, and with tax advantages in some situations. Many investment accounts now offer features that weren't available to previous generations. Brokerage accounts often provide debit cards that allow direct access to cash from money market funds or from the proceeds of investment sales. Some brokerages offer margin lending, allowing you to borrow against your investment portfolio rather than selling assets, which can be particularly useful if you need temporary liquidity, but don't want to realize taxable gains or interrupt your long-term investment strategy. The psychological component of emergency preparedness often matters more than the mathematical component. People who are terrified of running out of money tend to keep excessive cash reserves that create a false sense of security while guaranteeing real financial losses through inflation. A more balanced approach recognizes that the biggest financial emergency most people face isn't a sudden expense, but rather the slow-motion disaster of inadequate retirement savings caused by keeping too much money in unproductive accounts. Let's examine some real-world scenarios to illustrate how intelligent emergency planning works in practice. Suppose you face a $10,000 medical emergency. With the three-bucket system, you might pay for this using a combination of your first bucket cash reserves, a short-term loan from your credit card that you pay off by liquidating second bucket investments, and perhaps a small withdrawal from third bucket investments if necessary. The total financial impact is manageable, and you avoid keeping $10,000 perpetually idle in anticipation of an emergency that might never occur. Job loss represents a more significant emergency that might require sustained access to funds over several months. However, unemployment insurance, severance packages, and the ability to reduce expenses during job search periods mean that you rarely need immediate access to 6 months of full expenses. A more realistic emergency fund might cover 3 months of reduced expenses, supplemented by the ability to liquidate investments gradually if the job search extends longer than expected. The concept of flexible emergency funds challenges the traditional thinking that emergency money must be completely separate from investment money. Modern portfolio theory suggests that a well-diversified investment portfolio is itself a form of emergency fund, because the probability of all asset classes declining simultaneously is relatively low, and even during market downturns, you can often liquidate the investments that have performed best while leaving others to recover. For higher net worth individuals, emergency preparedness might involve maintaining relationships with private banks or credit institutions that can provide rapid access to substantial amounts of money, secured by investment portfolios or real estate holdings. These arrangements allow wealthy individuals to maintain emergency liquidity without keeping large amounts of unproductive cash, essentially using their assets as collateral for emergency borrowing rather than keeping emergency cash reserves. The key insight that transforms emergency planning from wealth destruction to wealth preservation is recognizing that true financial security comes from having multiple sources of potential liquidity rather than from hoarding cash, multiple investment accounts, credit facilities, real estate equity, and diversified income sources provide much more robust emergency protection than large savings account balances, while simultaneously building wealth rather than destroying it through inflation. Emergency fund planning should also consider the opportunity cost of excessive conservatism. Every dollar kept in low-yield emergency funds beyond what's actually necessary represents lost investment returns that compound over decades. The person who keeps $50,000 in emergency funds when $20,000 would be adequate has sacrificed potentially hundreds of thousands of dollars in long-term wealth accumulation for the illusion of additional security. We've reached the end of this financial awakening, and if you followed this journey from beginning to end, you should now understand why the title of this series isn't hyperbole or clickbait. Traditional saving isn't just ineffective in today's economic environment, it's actively destructive to your financial future. Every day you delay transitioning from a saving mindset to an investing mindset is another day that inflation erodes your purchasing power while opportunities for wealth building pass you by. Let's crystallize everything we've covered into one unavoidable truth. Money that isn't growing faster than inflation is money that's dying. There's no middle ground, no safe harbor, no neutral position in an inflationary monetary system. You're either building wealth through intelligent asset allocation, or you're losing wealth through passive cash accumulation. The choice is that simple and that stark. The traditional saving mentality made sense in a different economic era, but clinging to outdated financial strategies in today's environment is like using a horse and buggy on a modern highway. You might feel safer moving slowly, but you're actually creating dangerous conditions for yourself while everyone else speeds past you toward their financial destinations. The rules of money have changed fundamentally, but most people are still playing by the old rules and wondering why they can't get ahead. Throughout this series, we've dismantled the myths that keep people trapped in financial mediocrity. We've shown how banks profit from your financial ignorance, while paying you virtually nothing for the privilege of using your money. We've demonstrated how inflation systematically destroys the purchasing power of cash, while asset prices rise dramatically. We've revealed how the wealthy think about money completely differently than the masses, focusing on asset acquisition and passive income generation rather than cash accumulation. Most importantly, we've provided concrete strategies for transitioning from wealth preservation to wealth building. Regardless of your current financial situation, whether you're starting with $50,000 or $500,000, the principles remain the same. Educate yourself about investment fundamentals. Diversify across asset classes that can maintain their purchasing power. Focus on building income-producing portfolios rather than dead savings accounts, and develop liquidity strategies that provide emergency access without sacrificing long-term growth. The psychology of this transition is often more challenging than the mechanics. Breaking free from the saving mindset requires confronting deeply ingrained beliefs about money, risk, and security. It requires accepting that the behavior that feels safest, accumulating cash in insured accounts, is actually the behavior that guarantees long-term financial failure. It requires embracing a level of market volatility and investment uncertainty that makes traditional savers uncomfortable, while understanding that this apparent risk is actually much safer than the guaranteed purchasing power erosion that comes with cash hoarding. But here's what nobody talks about in conventional financial education. The biggest risk you face isn't market volatility or investment losses. The biggest risk you face is running out of money during retirement because you spent decades thinking you were building wealth when you were actually destroying it through inflation. The biggest risk is discovering too late that you're conservative. Saving strategy left you financially unprepared for the realities of aging in an expensive world. The wealthy figured this out long ago, which is why they don't save money in the traditional sense. They convert excess cash into productive assets as quickly as possible. They focus on acquiring things that generate income and appreciate over time. They use debt strategically to amplify their returns rather than avoiding it out of fear. They think in terms of cash flow and purchasing power rather than account balances and nominal returns. This isn't just about money, though money is the vehicle we've used to explore these concepts. This is about developing a contrarian mindset that questions popular wisdom and thinks independently about complex problems. This is about recognizing when conventional advice is outdated and having the courage to pursue better strategies even when they go against social expectations. This is about understanding that following the crowd in financial matters, just like following the crowd in most areas of life, is a recipe for mediocre results. The financial transformation we've described isn't something that happens overnight, but it's something that begins the moment you decide to stop accepting traditional saving as your default strategy. Every month you delay this transition is another month of lost opportunity, another month of wealth destruction through inflation, another month closer to retirement without adequate resources to maintain your standard of living. The choice facing you right now is simple but profound. You can continue following the financial advice that was appropriate for your grandparents' generation. Advice that guarantees you'll lose purchasing power over time while feeling good about your account balances. Or you can join the ranks of people who understand that building wealth requires rejecting conventional wisdom and embracing strategies that actually work in today's economic environment. If you've been convinced that traditional saving is indeed a trap, if you're ready to stop being a victim of monetary inflation and start building real wealth, if you want to develop the contrarian mindset that separates successful investors from perpetual financial stragglers, then your journey is just beginning. Hit that like button if this series has challenged your thinking about money. Subscribe to Contrarian Edge if you want more content that goes against conventional wisdom but delivers superior results. And comment below with your answer to this question. Are you ready to stop saving and start investing? The financial establishment profits from your ignorance and your adherence to outdated strategies. Your bank, your government, and your traditional financial advisors all benefit when you keep large amounts of money in low-yield accounts. Breaking free from this system isn't just about improving your personal financial situation. It's about refusing to participate in a wealth transfer scheme that benefits institutions at your expense. Welcome to Contrarian Edge, where we don't just think differently, we think correctly. Your financial future depends on the decisions you make right now. Today, with the information you've gained from this series, don't waste it.